Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas, and today we have the pleasure of interviewing Matthew Piepenburg. How you doing today, Matt?
It's great to be back, Darrell. I know you're kind of sick right now. I appreciate the time and you're feeling so down, but there's always lots to discuss with these headlines these days.
Yes. Life keeps going. Life keeps going, right?
Yeah.
As we speak, we're in the middle of a hot conflict with Iran, and I know that you have written about the dire financial situation of the United States. And so a lot of the talk has been, hey, can we even afford this war? And then we have President Trump wanting to increase the defense spending budget to $1.5 trillion. And there's been many asks for, I think, $200 billion was an ask recently and such. And so just curious in your thoughts on the financial implications of this war, even though there are some tragic parts of this, too. So I don't want to undermine that. But I know that it seems like we can't afford this.
Yeah, Darrell. I mean, gosh, when I think of last year, when the big conversations were de-dollarization or stablecoin legislation or the COMEX and the banking crisis risks and inflation, deflation debates, and that almost seems innocuous now. It's, at Von Greyerz, where I've been for many, many years, and we've been in business for almost over a quarter of a century, I think about, and we'll get to gold and markets, but our primary thesis has always been that, real money is gold and you need to hold a physical asset for wealth preservation to protect against debt risk, which is now 39 trillion public debt in the U.S., currency risk, banking risk, market risk, and of course, historical risk. And so that narrative hasn't changed. It's only being confirmed now. And it's crazy because right now, and we'll get into the weeds of the markets and the gold price, of course, that is incredibly relevant, but you can't ignore the macros now in a nonpartisan way. It's hard to not be nonpartisan or critical or supportive, whatever your position is. And guys in markets and commodities or precious metals or risk assets aren't, we're not here to give political opinions, but politics do affect economics, and economics, as Clausewitz says, affect headlines in war. And we're now in this macro setting of war, of Trump, of debt, of U.S. hegemony, of currencies and metals, et cetera, in the headlines in 2026. But it all still goes back to the Von Greyerz thesis, my thesis, Jeffrey Gundlach's thesis, Ray Dalio's thesis. It all starts with debt, and again, the U.S. has just passed 39 trillion in public debt. Globally, the world's at 355 trillion public and private debt. The interest expense on Uncle Sam's bar tab right now is 1.4 trillion. We run a $2 trillion annual budget deficits. Because of this war, we're looking at extreme oil-driven inflation. We're at the acceleration phase of a sovereign debt crisis, not just in the U.S., but in Europe, certainly in Asia. Japan is a classic example. And with debt levels this big, look, something has to break, and I think that's going to be the markets, and then we'll talk about it. But, to your original question, the WTF, right? What are we doing right now? Can we afford this war? What is ramifications economically, getting past our opinions on it? If we just look at the objective data and draw our own conclusions. And I'm in Europe most of the time now. I'm an American. I have an American perspective. I certainly talk to a lot of Americans in the service and outside of the military, in public and private life, in market life. I talk to a lot of Swiss, German, French, obviously European perspectives. And the questions they're asking, I don't always have the answers to, and we all have our opinions. With this particular war, Darrell, what happened to Trump 1.0 to 2.0? He was elected in the 2.0 version on a platform to avoid a foreign war. He said no to Israel, as did Bush and Clinton and Obama in the many years in the past. And certainly Trump 1.0 said no to these kind of proliferations with Iran. Now he's saying yes. There's a potential, and again, I'm not a military expert, but there's certainly a potential for a strategic military and a defeat or victory. We don't know what that looks like. Certainly there's economic ramifications now and costs. There doesn't appear to be a plan A or a plan B every day we get victories being claimed. Like, it kind of reminds me of George Bush Jr. on the USS Abraham Lincoln declaring victory in Iraq, and that's still a mess there. And the question is, in terms of the economics and the inflation, and if oil keeps rising and rates keep rising and costs keep rising and bar tabs keep rising and interest rates to pay that keep rising, is Trump mentally, leadership-wise, pride-wise, humanitarian-wise, politically-wise, whatever your opinion on him, is he going to fold or double down, Even his base, which aren't always Exxon or Chevron executives, even his base is suffering right now. His vice president is scratching his head, and he's a former military guy, Tulsi Gabbard, who I've spoken to in the past. I wonder what she's thinking. We've seen other kind of different views in his own staff. But what was the motive here? Again, I'm not here to give a political motive. If I look at it purely economically at this war, it is a direct war between the U.S., Israel, and Iran, but it's also kind of a proxy war against China economically because of the petrodollar, which I've written about for years, is so critical to absorbing U.S. dollars and U.S. treasuries. It's a critical part of American hegemony. I don't think it's a coincidence that American foreign policy and wars find itself in places like Libya, Iraq, Iran, Venezuela, because these are oil nations. Prior to this war in Iran, the Chinese were mediating openly between OPEC and Iran. That was not something the U.S. likes because Iran sells its oil outside of the petrodollar. Other countries that have tried that in the past, Gaddafi and certainly in Iraq, both of those leaders ended up not surviving very long. And Iran's leader didn't survive either in the first salvos of this war. So America takes that petrodollar very, very seriously. And the idea of Iranian oil being sold outside of the dollar is scary. Again, I'm not saying that's the only motive. It's one I can think of economically. I think China is sitting back and watching the U.S. spend itself and shoot itself in the foot here. And it's a gift to China because that's the real other threat to American hegemony is the economy that is China. Now, as far as the other motives, blackmail, Epstein, I have no idea. What I do know is there is a lot of discord in the party, in the country, in the U.S. You've got guys like Colonel Lawrence Wilkerson citing a Brown University study where I was an undergrad that U.S. sanctions have led to over 38 million deaths throughout the world since 2000. That's a hard figure. It doesn't look like spreading democracy. I know that I'm very American. I'm very patriotic, but these are numbers that seem to be fairly disturbing, and we'll see how critical they are. But getting past left versus right, you've got a lot of military folks like Douglas McGregor or Colonel Wilkerson, who was on Powell's staff. You've got J.D. Vance. You've got guys like Sean Ryan, other military veterans who said this seems less like democracy and more like an empire. And we're getting a very slow casualty drip out of the official channels. We saw this in World War I when we had 110 days and 110,000 dead. Again, I have no idea as of April 3rd where the headlines are going to be this afternoon or tomorrow. I'm not certainly hoping for a bad result for America or anyone else. But this war, in an economic sense, has some drivers that I can understand and some ramifications that we can look at. It's certainly the inflation to deflation conversation, the dollar conversation, what it will do to markets. But this is crazy, and we can take it on any thread you want to pull. But it's going to have massive impact on our debt, massive impact on our dollar. It'll have massive impact on the markets, and it will certainly have an impact on the gold price longer term. Definitely heading into the weekend. Obviously, markets close today, Friday, April 3rd, going into Easter weekend. Maybe they'll play nice for Easter, then go back to blowing shit up or whatever. But who knows, right? Who knows? So the proxy war and the petrodollar. I'm curious in your thoughts there, because when Iran came out and said,
we will allow for passage of the strait for, I guess, tankers or oil exports that are sold in Chinese yuan, which was pretty interesting, for them to come out and say that, and it was pretty direct. And so curious in your thoughts there on the petrodollar and the competition from the Chinese yuan.
Yeah, again, you can't underestimate the importance of the petrodollar to American hegemony. America has this exorbitant privilege to be the world reserve currency since Bretton Woods in 1944. That was John Connolly's famous expression, it's our currency, the rest of the world's problem. We can print and create more dollars as much as we want and expand the debt as much as we want. We can debase our currency. But if the whole world needs the US dollar for SWIFT transactions, for derivative trades, for Eurodollar expansion, credit expansion, but most importantly, if the world is forced since the early 70s to pay for its energy in dollars, that's a massive sponge for otherwise debased, unwanted, overproduced dollars. So it's actually quite brilliant when Kissinger et al. And Nixon's kind of clan created the petrodollar arrangement in the early 70s, because that really was an exorbitant privilege. If you could get OPEC, basically at knife point, if you read the history of that, to agree to the petrodollar and the fact that oil has to be bought in dollars, and then those oil-producing nations have to use a lot of that revenue to buy U.S. treasuries. Well, that was a massive tailwind for the U.S. dollar. That meant we could, unlike any other country in the world, we could expand our currencies at a greater rate and have them absorbed at a greater rate, so that we wouldn't end up like the fall of Rome or the fall of 18th century France or Weimar Germany, because there was this forced synthetic demand. Any threat to that petrodollar is terrifying. And the power of that petrodollar is terrifying. So if Iran wants to let a tanker go through the Strait of Hormuz to sell oil in yuan, that doesn't help the U.S. Again, China just sits back and watches us shoot ourselves in the foot. They know what's up. It's extremely important to the U.S. dollar and hence the U.S. hegemony, because to be a world reserve currency and to be a military hegemon, both are linked together, as Kissinger said. You can't be one without the other. So this oil trade is more than just a headline for bad guys. And I'm not pro-Iran, I'm not pro-regime, I'm not pro-Hamas. This is axiomatic. But you can see the realpolitik, the economic realpolitik. And the U.S. doesn't even need victory. It's like a military Keynesianism. We just need constant war. This is something Eisenhower, when he passed the torch to John Kennedy in the early 60s, it was his last famous address. This is a four-star general, the hero of World War II, the hero of Normandy, a West Point grad who was very concerned about the military-industrial complex. And in this type of control where our policy is really driven by military objectives, they don't even need victory. They just need to keep the churning, the Raytheon money churning, the military war dividend churning. Again, that may sound anti-American. It's just being realistic. We've had madmen in the past. I think Nixon was one of them. He blew up the post-44 Bretton Woods system in which the whole world believed on a fixed exchange to a gold-backed dollar. That led to kind of a golden era of American capitalism in the 50s and 60s. But that ended in 71 when we got off the gold-backed dollar. And even we then had an oil crisis, which if you read Kissinger's biography, he admitted that the U.S. started it, that we started this. And he said, yes, the oil price hurt America, but it hurt the rest of the world more. So in a sick way, it gave us relative hegemony. And even Trump has said recently, I don't mind if oil prices go higher. We're an oil producing nation. But Kissinger also said to be an enemy of America is dangerous. To be a friend of America is fatal. That kind of arrogance, that kind of need for relative hegemony isn't helping allies or countries like the UK or India or Bangladesh or Turkey or even the OPEC nations right now following our policy, because we are creating stress in different areas of the world, including among our allies. But we're oil producers. But this isn't even helping Trump's base. If you were his political advisor, you would see that unemployment and interest rates are rising. AI, which is what's holding up the S&P, is very energy and oil dependent. Investment in the NVIDIA world is waning. So he's creating more than just a chest puffing moment for American petrodollar or dollar hegemony. He's putting the economy at risk. He's putting, quote unquote, allies in other countries at risk. And it is an exorbitant privilege. It's an arrogance now for which we don't know how it ends, in a good kumbaya moment of peace and love or an extended and dragged out war. I have no idea. The military folks that I do see and read are pretty pessimistic. That's all I can say. I certainly have no criticism of American servicemen and women. I've always said over and over that they're lions being led by donkeys. My whole family has a history in just about every American war or European war. I'm very patriotic, but I'm concerned about this. And again, many of the former servicemen that are kind of speaking out today, and certainly men I know now who are in the military, aren't quite sure what we're doing here. But I do know that's going to have an effect on the dollar. It's going to have an effect, as it already is, on the markets. Those impacts will be devastating for Main Street, which is already, suffering massive unemployment and job losses, which you can get into the Main Street indicators. I'm not just saying this. There's plenty of data behind it. This is the worst time for such a crisis, especially when it's not a clear outcome or a clear motive. None of us really understand how this happened.
Yeah, for sure.
Circa 2020, we pivoted the entire company, turned on its head, brought in new management, George B., our CEO, who's built gold mines all over the planet, and we focused in on CK, copper cake. It was not reliant on drill holes and discoveries. We can go through this process, engineering, permitting, get towards a development stage asset. US Gold Corp is a near-term, low-cost gold producer in Wyoming. To learn more, go to usgoldcorp.com.
Let's get over to Wall Street / Main Street. Not too long ago, the former Attorney General Pam Bondi touted the Dow at 50K, right? And was saying that Americans' retirement portfolios are booming. Their wealth is growing and such. Markets have been rolling over since this conflict started, and it's been very volatile. But the Dow and the S&P and such, they're all in correction territory. And ultimately, this also impacts like tax receipts, which is another way of funding government spending or whatnot. And so, just curious in your thoughts on the markets in general.
Look, of course, as I kind of introduced, again, Main Street is really hurting when we get into the data, but if you look at the markets, we know Pam Bondi, whatever, politicians have to say what they have to say. I think they have to lie to keep morale going. Whether it's inflation or market stability, they clearly don't understand market cycles. But stepping back at 30,000 feet and then looking at 10,000 and 5,000 feet, the first thing I would say about any political party in the White House, left or right, center, red or blue, debt and spending just isn't going to stop. Deficits aren't going to stop, especially in a war. So something will break, and I think that will be the markets, the bond and stock markets, and that'll affect the currency markets. But the bond yields are rising as the economy is slowing. And rates are going up because credit is tightening, and refinancing, whether it's at the Wall Street level or at the household level, is going to get harder. Again, and I've been writing since 2025. I'm not alone in this. Many of the bond experts and bond traders I talk to religiously, because I think the bond market is the thing. I think the crisis will probably come from the private credit markets, private equity and private credit needles point at this market bubble. I think the next crisis will be in private markets. We have to remember, look a little bit back in history, not that far back, into 2008, and how it overlaps right now with 2026, or the setup. Private credit is a $2 trillion space, roughly. It's about the same size of the subprime. And I've written a lot about private credit and spoken out loud about it for months. The valuation marks in these private credit pools, which are not marked to market, are completely off. The marks are completely off. You can have, I won't say a particular name, you could pick it could be Apollo, BlackRock, Blackstone, fill in the blank, even Morgan Stanley, private credit, whatever offshoots of those, private credit sponsored by banks, that is, they can have the same book of credits, and on a scale of 1 to 100, 100 being a good valuation, different companies are valuing the same book at 85, while someone else is valuing it at 8 or 10. There is no weekly or daily update on the true value of these non-mark-to-market private credit cesspools. It's not even like ABX, which was the index for subprime in 2007. If you remember, that index said all our subprime mortgages were AAA rated. They were, in reality, just horse crap put in a Tiffany's bag and propped out to the world as AAA credits. It just wasn't true. But even the ABX in '07 at least give you daily numbers. With private credit, it's quarterly. So there's been a lot of dishonesty about valuing these assets and these private credits. I think that $2 trillion private credit market is just very similar to the $2 trillion subprime market. And when you compare it to 2008, again, history doesn't repeat, it rhymes. But remember, may or not remember, in 2008, subprime mortgages were about 13% of our total mortgage pools. And of that 13%, 25% of those mortgages did default. And of those defaulting mortgages, that comprised about 5% of U.S. mortgages defaulting. But that was enough to create a major global crisis in the markets. Just that small, fragile subprime mortgage market. What we have in these private credit and private equity markets is a similar tipping point in an otherwise very fragile market. It doesn't take a complete global disaster in subprime or a complete global disaster in private credit to domino and contagion effect an otherwise very vulnerable S&P market and therefore global markets. And when you combine what's happening in the private credit space from, the big names, these are the smartest in the room, they're all gating their funds and they're marking their book values down. That's very dangerous. We also have an AI needle. AI saved the S&P in 2025, but energy costs, like I said, are rising. If oil keeps staying at these levels, that means, the energy needs of AI and AI infrastructure are going to wane. So we have a stock market that's very fragile to these type of needles pointing at it. The top 10 names in the S&P have more cash than the bottom 400 combined. So that is concerning. Bitcoin, whatever you think of Bitcoin, I'm not here to get into a debate to upset or support Bitcoin listeners. But Bitcoin, to me, has always been a leading kind of indicator. And when there's massive sell-offs in Bitcoin, especially as we saw at the end of 25 when gold was ripping and Bitcoin was cut in half, when you see sell-offs in Bitcoin purely as a market indicator, we're not getting into the substance of it, you see this sell-off in Bitcoin as kind of a move from aspirational risk on to cautious risk off. I mean, Jeffrey Gundlach, again, said that, Bitcoin's kind of like Facebook. It's not cool anymore. They're not, and again, many Bitcoiners will disagree with that. I'm not here to say they're right or wrong, but I think as a leading indicator, Bitcoin's interesting. But most importantly, I think people are still worrying about some of the wrong things. As important as gas prices are, I know in California that's over $6. I think in Hawaii it's even more than that, $6 a gallon. And they're worrying about rising gas, and of course they should. But what they're whistling past is that the U.S. government just passed $39 trillion in debt. That to me is extraordinary because again, when you compare where we are today in 2026 as a setup in private credit risk, as we were in 2007 or 2008 as a setup for the subprime risk, we are in a much more dangerous scenario now in 2026 than we were pre-08. Derivative exposure today is 10 times higher than it was pre-Lehman. And then you tap onto that, this private credit needle pointing at us, this AI bubble, and then you have a war with rising rates and rising costs, and you have a middle class literally, quantifiably on its knees. Because on Main Street, the BLS non-farm payrolls came out, we lost 92,000 jobs. We've had 13 months of real-time revisions, consecutive real-time revisions to employment. In 2025, we didn't not only see no new jobs, we saw a destruction of jobs for 2025 net. And Macro Edge predicting, like Challenger Grain Christmas, far more credible than the Bureau of Labor Statistics, are already predicting more job losses for March. And so the market's trying to price in 2 rate cuts on these things, but I don't think that's going to happen. I don't think we're going to see the rate cuts. In fact, we might even see a rate hike for different reasons we can talk about. But you couldn't ask for a worse backdrop on Main Street, on Wall Street, and geopolitically for us to be going into such a conflict right now. It's more than a distraction or a bad idea economically. Again, not here to talk about State Department or foreign policy or military success or failure rates. It just economically, this is a really dangerous time to be pulling off these kind of decisions right now in the Strait of Hormuz.
Okay. Yeah, thanks for sharing that. Okay, so I want to talk about gold. So you recently put out a article that talks about gold's biggest fire sale in 43 years, perception versus opportunity. It's a really good article. I encourage the audience to go check it out. So just curious in your thoughts on gold's behavior in reaction to what's happening with this conflict in Iran, as most people would think that this should be bullish for gold. Gold's been heavily correlated with whether President Trump tacos or doubles down on the conflict, right? You can see the gold price just kind of whipsaw and such with the markets. And so just curious in your thoughts on gold in relation to this conflict.
Yeah, again, I mean, I obviously have a clear bias and a high conviction. If you can imagine, to get beyond my bias for a second and just look at this in the longer term, I've never been more confident, and none of us at Von Greyers have ever been more confident about gold's longer term direction. And that's not just an apology from Zurich and a gold vault and a private gold vaulting service, but I understand skepticism. You know, for me and many others outside of the gold space, again, especially those in the bond markets who understand credit risk and currency risk, gold really is real money. And central banks have been seeing this. Pre-1971, central banks held 70% of their reserves in gold until Nixon welched on the Bretton Woods system. Today, gold is only 30%, and it will get to at least 50%. Gold is, up until this war, becoming the de facto primary reserve asset. It's the new FX reserve currency, 40% US dollars, 35% gold. We saw central bank gold stacking go up 5x since 2022 when we weaponized the dollar in the last war. We were a proxy war win with Ukraine and Putin. So there was clear de-dollarization trends, there was clear gold stacking trends, and those trends aren't going to stop. But we can't deny what has happened since this war began, this black swan or gray swan, or some would say white swan event. You can't deny that there's been massive sell-offs in gold. We need to explain what's going on, put them into short-term and longer-term perspective without sounding like an apologist. The war sell-offs, and again, this is in the background of, gold loves chaos. What could be more chaotic than the headlines today? Why isn't gold at 6,000 or 7,000? It will be, but why isn't it right now? And this is what I call the great paradox, where you have to sell good assets, like in a margin call in a stock market crash, to pay for the sins of your bad assets. So you sell your most liquid and valuable assets. That's not just an apology or a dramatic statement. The numbers are there to show it. I use a couple of examples. Turkey, for example, which has been stacking gold religiously in the last few years since we weaponized the dollar against Russia, just sold 10% of its gold in Switzerland. It just did a swap. Now, a swap is kind of like a pawn shop. It's swapped. It means it can come back and get it later. They can kind of like putting grandma's jewelry there and then hopefully getting it back. But they just sold 10% of their gold swaps in 2 weeks. That's 60 tons of gold they swapped. That's greater than the 43 tons of all ETF gold sold since the war started. So why is Turkey, which loves gold, having to sell its gold? Sadly, it's because 90% of Turkey's oil and gas is imported. And so when you have ripping oil prices because the Strait of Hormuz is clogged, every $10 increase in the oil price is another $5 billion in costs for countries like Turkey. So they have to sell their liquid, most valuable asset to create enough dollar reserves to buy petrodollars. This is how the petrodollar is the tail that wags the dog of the rest of the world. So that's an example of a major sell-off in gold. Of course, that's going to push the price down. The other interesting example I use is Saudi Arabia and the other Gulf states. Obviously Saudi Arabia and the OPEC or GCC nations have a lot of oil, but they also have to import 80% of their food. Their military costs are rising, and a lot of expats with a lot of dollars are leaving those zip codes because of the missiles flying. So there's a major drain of their dollar reserves. And since they cannot get new reserves, they have a lot of oil, but they can't sell the oil right now, and they can't get the same revenues. So these countries, our allies, again, never be an ally of America, have to replenish their dollar reserves because their dollar revenue is clogged. So unofficially, and again, don't quote me on this, but unofficially, and the IMF doesn't have to report it, and Saudi doesn't have to report it, what we're seeing with the flows is probably, and I can't confirm this, so I'll caveat that, at least 45 to 50 tons of Saudi gold has been sold since the war started. Again, not because they want to, but because they're forced to. So these forced sell-offs are really temporary headwinds, obviously, for gold. Obviously, also, with Von Greyerz, we're all about wealth preservation. Our clients are all about wealth preservation. It's all about long-term thinking and recognizing that paper currencies, including the dollar, are just melting ice cubes. In the long run, gold always gets the last laugh. When gold was ripping into the end of 2025, I say a lot of tourists came into the gold space and they wanted to trade the momentum. So they're buying a lot of ETFs, which is the last place you should own gold if you're into wealth preservation. And when they were buying these ETFs, they were typically buying 2 to 3x levered ETFs because they were speculators. They weren't wealth preservation thinking. I understand that. They saw a momentum trade. They wanted to get in. They wanted to lever. When gold was ripping, those leverage trades on ETFs made them look very smart. But when gold corrected during the war, be careful who's over-levered because those ETFs have to rebalance daily and cover their margins. So there's a massive sell-off in the ETF space. The other place where there's not wealth preservation thinking, but speculators are hedge funds. And they were trading on algo trades, riding the gold momentum until this war. When they get a sell signal, they all sell en masse. They're not there to preserve. They're there to make profits and swing trades. So all of these things combine to be a real temporary but real, headwind to gold. For those who understand gold as a wealth preservation asset, as literally life insurance for dying currencies, these are just buy signals. And our smartest clients are picking up the phone and buying more gold into these markets because they're thinking 5 years, 10 years out. And again, I can get into a ton of different data points on gold ratios to the money supply or the gold price versus foreign held U.S. treasuries. We are not even close to all-time highs in gold. We're 50, 60% off. And these pullbacks are just buying opportunities. But the other thing is, and I'll end with this point on gold, gold will be revalued to offset debt. Besant himself, even before Trump was in the White House, wants higher gold prices. We don't have the same fear of rising gold as we did in 2011 or 1980 when Volcker said gold was my enemy, or some other said gold was to the dollar like the sun was to vampires. We actually need to let gold run to pay down some of our debts, to revalue gold. I've written about that too. But all of these forces combine longer term to suggest we're only in the second or third inning of gold's bull market. This is not a momentum trade. Gold is a new superior reserve asset. It's a store of value that's better than even the world reserve currency. So these forces right now in the smog and fog and smoke and oil of war are easy to shake out a lot of people. And bull markets always shake out a lot of tourists. And it's sad. They usually get out at the wrong time. We saw this in the great bull market between 71 and 1980 with gold, where midway through in 1975, there was a major shakeout in gold. A lot of people sold at the bottom and then missed the whole ride up. But again, we're not trading gold at Von Greyerz or those who understand physical gold outside of the banking system as a preservation asset. This is a buying opportunity and not a sales pitch from a gold apologist.
Yeah. So with that important point in mind, how much liquidity do you think people may need in this type of environment? So I know quite a few people there, stacking up on some cash, some T-bills. I've been holding a little bit of T-bills just for liquidity. And then, because gold is ultimately being sold for these nations to get liquid in this type of volatile environment. So just curious in your thoughts on gold ownership, buying gold, continuing to have a long-term outlook on that, but also maintaining immediate liquidity.
No, these are important questions. And again, it's frustrating because I know for many listeners, gold, whether it's at 5,500 an ounce or 4,700 an ounce or 4,200 an ounce or 6,200 an ounce, is extremely expensive. it's hard to just buy an ounce here and there, especially when you look at the status of the middle class, which I call the working poor, this massive wealth transfer that happened in the last 10, 15 years, especially since 2008, when we inflated the QE, we inflated the money supply, we inflated stocks and bonds, and we inflated real estate. But many people realized that they weren't in the markets. They didn't have the real estate. They didn't enjoy that inflation. Inflation is not color or class blind. It only benefits the top 10%. It guts the bottom 90%. So for many who are trying to preserve wealth, they haven't even been able to acquire wealth to preserve. And when you're asking how much gold can I get, how much dollars should I keep in liquidity, again, if I were trying to protect myself longer term, I wouldn't want to save anything past, I certainly wouldn't want a USIOU or Treasury past 5 years out on the duration curve. I wouldn't want anything past a 2 or a 4 year Treasury. I wouldn't want to save in US dollars, even if the DXY, which isn't really ripping as it should, even if the DXY is at 100, it's certainly not going to be at 150 like the milkshake theory says. But I don't think saving in a melting ice cube is a good bet. If you're saving cash because you're worried about banking risk, that's a different thought. But I realize that it's not easy just to go out and buy an ounce of gold. And I realize that that's kind of empty advice to those who are worried about mortgages and tuition. For those who've already been stacking gold an ounce at a time or a gram at a time, I would again, and they're not clients of mine. I have no horse in that race, but I would say don't sell unless, like Turkey or Saudi Arabia, you have to. If you can hold on to that, you're going to be rewarded longer term, as you were rewarded in 2025 and even this year at the gold price. Even right now as we speak, if you were buying gold years ago, even these pullbacks aren't that scary. I think what investors need to get is more than just one YouTube interview from a gold bug, is they need to get conviction on why they own gold. They need to look at the pros and cons of gold. But if you look at the longer term history and the math of currency debasement, of credit cycles, and the longer term last laugh that gold always gets on debased paper money systems, which are clearly openly stressed right now. That's why we're seeing this desperation. That's why we're seeing these war headlines. You'll have the conviction to handle retracements or sell-offs like this, politically driven sell-offs, to save for the longer term. It's very hard to have that conviction if you aren't informed. And again, that won't come from just one guy who operates the largest private gold vault in the world selling you his book. You should be skeptical. But if you look beyond Von Greyerz or our partners and my founder, Egon Von Greyerz, if you look at Jeffrey Gundlach, if you look at Morgan Stanley, if you look at the central banks, if you look at the BIS, they're all doing the same thing that we're trying to tell you. Save in gold, spend in fiat, think longer term, not short term. And again, many who are listening aren't going to become a client of Von Greyerz, where our minimums are very high, but our message applies to anyone who's worried about the melting currency that they measure their portfolio in or they measure their wealth in. Some allocation to gold is essential. It's hard for those who are just trying to get by. I get that. And in addition to what I've talked about with gold, I can't call the end of a market. I can't time a market bubble. But like Jeremy Grantham and many others, or Jeffrey Gundlach, or Ray Dalio, or Michael Burry, or anyone who is actually managing risk in these markets, this is not a time to be chasing tops or doing the greed or fear trade. And especially in the risk asset markets, they could bluff higher for longer. I don't know. I think Powell will probably raise rates if he isn't, put in jail by the Trump administration or criminalized or arrested. It doesn't matter rates up and down. Longer term, this market is a bug looking for a windshield. It is a balloon looking for a needle. I think it will be private credit, possibly AI. The combination in the private sector of private equity and private credit will probably pop this, but I don't know. Something will. The debt levels, as I said at the beginning, are too untenable and unsustainable. They have been for a while, but what we're seeing right now with the geopolitical risks, in addition to the inflation risk and even the deflation risk, because deflation is certainly going to be, inflation creates its own deflation. As gas prices rise, as consumers buy less and our economy stalls. We could have an official recession, even though I think we've been in one for 4 years. We could have an official recession. It could set up a market crisis like it did in 2001. I do not know what the needle will be, This is not a time to believe that your 401k will look the same in 2 years as it did 2 years ago. This is not the time to rely on 60-40 stock bond portfolios or the US dollar being hegemonic forever. What we're seeing in the short term, I think, is lulling people into some real concern now. I would not be high into US markets, US equities, and many, many very powerful hedge fund managers today, who I won't name, but they rhyme with some of the men I've mentioned already, aren't even buying US equities. They're buying equities outside of the US. They're looking for real value. I think, again, long answer to a short question, Darrell, but yes, if you can afford grams or ounces of gold and you can think longer term, you will be rewarded in the next 10 years as you were in the last 10 years. And you've got to be conscious of the risk in your 401ks in a standard diversified credit equity portfolio. Those are very dangerous right now. And you've got to be prepared for deflationary forces in an inflationary environment. And you've got to be prepared for the end game when debt is this high. The U.S., I have no doubt, will debase its currency to inflate its way out of this debt, and they will use war and other things as a distraction or a war dividend, but it's not a long-term solution, regardless of how this war is resolved one way or the other.
Yeah, thanks for that insight. That was very good, very good. Well, Matthew, I appreciate you coming back on the show and everything. So you put out these publications periodically. Where can people read some of your thoughts, maybe submit some questions or things of that nature? Mm-hmm.
Yeah, well, our website is vongreerts.gold or vg.gold. And the website has a section that's just why gold. It's a free education. It's free information. All of my articles, Egon von Greer's articles. We've got other advisors you can read there. Alistair McLeod is one of our advisors. Ronnie Sturfla from the In Gold We Trust report. So there's a wealth of free data there. Obviously, high conviction gold data. But there's a wealth of information there, and there's articles about, why gold, and not just why gold, but how to own gold. So that can be found there. If you want to contact me, you just have to hit the Contact Us button on the bottom and ask for me there or anyone else there, any of our partners. If you're interested in buying gold through us, of course, we certainly will reach out to you directly. But the website is free. Information is free. To me, that information is more powerful sometimes than just dollars and gold, but it's really important to be informed and also to look at other alternative asset classes and even to look at some tailwinds. Like I said, headwinds and tailwinds for gold. I've never said gold goes in a straight line, including when it was ripping last year. These retracements to me are not at all unusual, technically or fundamentally. I think if you understand why they're happening, it'll give you more conviction to be a longer term gold holder against paper money system that just isn't credible anymore in this debt cycle.
Yeah. Thank you for sharing that. You all have the information. Be sure to go check out vg.gold. Thank you, Matthew, for coming back on the show.
Oh, thank you, Darrell. It's always a pleasure. I hope you feel better.
Thank you. And you all be sure to hit the subscribe button if you haven't subscribed yet. We'd love to have your support.